Wow, we had so many great panels, and all the information that was thrown of us is unbelievably impressive. But we try to keep on raising the bar as we go along today. We got a wonderful panel with 4 different aspects of effectively the core infrastructure that is required to move this market into the next stage. We all have been discussing how the VCM should grow, how do we get institutional capital more involved in this market to really ramp it up. And to that extent, we got 4 great panelists, and in no particular order, but we got James from Kita. Insurance will play a massive important role to ramp up the market. Investors do need certain protection. As I always say, they don't fear risk, but they fear uncertainty, and therefore insurance plays a critical role. Then we got Tommy from BeZero. Super important as well, because if there is no rating agency around for this space, people get nervous and would like to hear more about how BeZero see itself compared to, let's say, the credit rating agencies. Then we got Greg from Fifth Wall. If you need money, talk to him. He spreads it around. I'm sure if you find some time to chat after this panel with him, it would be great. He has a very impressive background. He worked at BWI Ventures, but also at the boring company Neuralink. So if you want to have any insights on how it is to work for Elon Musk, have a chat. And then last but not least, we have Till, who is the co-founder of Maya Climate. It's a project organization, a risk management platform for pre-issuance of nature-based solutions. I think you have done over 50 projects now, so a lot of knowledge there. But also interestingly, they just raised a new pre-insurance risk assessment platform, which I would like to hear more about. But James, let's start with you. As we are building the core fabric on getting institutional capital more and more involved, how do you see Kita? What was the reason that Kita was founded, and how do you see Kita playing an instrumental role to this market?
Yeah, sure. Thanks, Bart. Hi, everyone, and great conference, by the way. This is fantastic. So James from Kita. I'm head of insurance, so I'm the token insurance person on the panel. Kita, we insure carbon. Our mission is to de-risk the carbon markets with bespoke insurance products, and we think that by de-risking the markets, that will help unlock institutional capital that the market needs. We do that by looking big picture at the carbon markets, thinking about all the stakeholders in the value chain, thinking of the life cycle of a credit, and thinking of all the kind of carbon project types, and we're building bespoke products for those. We're trying to target the real gaps in priority order. The main one we saw was around the lack of supply for high quality projects. So we focused on de-risking those pre-purchases for buyers or investors that are looking for a future stream of carbon credits, and then we make them whole if those carbon credits are non-delivered. We think about it in terms of avoidable risks, unavoidable risks, and the carbon market risks. So avoidable risks would be the risk of default of the developer, your fraud, your negligence, your abandonment, all those kind of credit default type risks. Unavoidable risks would be your classic insurance risks, so your physical risks, and like the chair mentioned, wildfire, asset impairment is a huge, very growing risk in the climate space. So any kind of physical risk that impacts the delivery of those credits. And then lastly, the carbon market risk, so the risk of invalidation of a standard or a methodology that really undermines the credits that are being issued. So I'll stop there, but that's our mission.
Tommy, when you founded BeZero, for sure you had something in mind that your services weren't around, or would it not be developed by one of the other rating agencies? So tell me a bit about your thoughts, why you have done what you did, and what it is that you bring to the market to fill a gap.
Thank you for having me. I hope you can hear me. So we're a carbon rating agency, so it's similar in the sense that we deal in the risk language of assets, but we don't look to insure them. We look to provide fundamental analysis for every member of the value chain to make better informed decisions about what they're buying. The problem we're solving is how do you assess quality in the carbon market above and beyond accreditation, and also how do you make a risk-based approach to making either an investment, retirement, or development or trading decision. How do we come into it? I love to say I was working in New York, left and thought, oh, what I really want to do is a carbon rating agency. I think what we did is we spent about a year just looking at the climate transition space and saying what were some of the biggest problems that were emerging. My background was in equity research at Bank of America. My partner was in fixed income. And we just started getting into this thing, okay, what is a carbon credit? What is it? It's this financial instrument, it's a contract, is it a commodity, it's not a commodity? And how do you prove that it's actually delivering what it claims? And so, and then a lot more people, increasingly so, started to get into this debate of, right, I could get delivered everything from a engineered removal, DAC, direct air capture, through to a mangrove, through to a fugitive emission, to a renewable energy project. Some of them are 10 cents, some of them are $1,000, but they're all the same. Well, obviously they're not all the same. So how do we get through this? And I think our approach is simple. A risk-based approach to assessing asset quality is a much more scalable approach than just taking a stamp and saying that's the end of the conversation.
And Till, if you could tell a bit about your platform, what is it contributing to this market, and why have you taken the route you have decided to take?
Sure. At mine, so our mission is really to accelerate investments in nature. When we started out, we saw most innovators were focused on the spot market, whereas we thought there was a great opportunity to build in the pre-issuance segment. So when I say pre-issuance, it's everything from a project being at a pre-feasibility stage to just being days to their first credit issuance. And so the reason we focus on the pre-issuance segment is because effectively that's where we need the money, right? So if you want to have new supply coming to the market, we got to finance new projects. It's also 5x bigger than spot markets, and it's probably even more opaque than spot markets. So that's why we decided to work on the pre-issuance segment from day one. And then the second focus that we have is that we focus on nature-based solutions because they're highly cost-effective and kind of immediately available to scale right now. And for investors looking to finance pre-issuance nature-based solutions, we saw a few problems. First one was really just market access. Developer landscape is hugely fragmented. 80% of developers develop one project in their lifetime. So it's, as a new investor coming into the space, really hard to identify where the projects are. Second was that there is no standardization around which risks to look at for a pre-issuance project. And the third one was really about creating benchmark data. So if you want to invest in a pre-issuance project, you're really much interested in understanding the cost structure and the carbon potential of a project. And you want to benchmark all your investment opportunities to other projects out there. And we want to create that benchmarking opportunity for investors.
Great. And Greg, with those three functions now in the market, your life has become super simple. Everything is being presented on the silver plate, and then you pick and choose. So tell me, how do you want to make use of those new functions? Because in the olden days, you had to do everything by yourself. There's now coming more and more services online, so to say. How do you see interaction with insurance, with rating agencies, with platforms going forward?
It's I'd say it's necessary, but we are nowhere near where we need to be. So
guys, pay attention.
Yeah.
This is what the client.
This is what the client wants. So just to give people context for where we come from, we're the world's largest venture capital fund focused on the built environment, and also the world's largest climate fund focused on the built environment. And the built environment, by the way, releases 40% of the world's CO2 emissions. It's the largest emitter out there. The reason why we are really the voice of the customer here is we sit in front of about 117 corporate partners, everyone from Hilton and Marriott through to your REITs, through to construction materials folks, who cumulatively across all of them are emitting round about 1 billion tons of CO2 per year. And our number one sort of takeaway from doing a very deep dive into this space is corporate partners frankly don't actually want to deal with this stuff, right? And I know that's a controversial thing to say at an event like this, but it's that the same way that a CFO at a Fortune 500 company doesn't deal with FX risk, they outsource that to the FX hedging desk at JP Morgan or Goldman or someone like that. If we want the fat middle of the market to actually start really taking part in this market, we have to make it look as institutionalized, as deep, as liquid, as insurable, and all of these things as any of the other things that they are trading day to day, where their CFO can call up a reputable person like a JP Morgan or someone else and just say, hey, I need the same way I've got a collar hedge on my British pound risk, I need the same thing on my carbon risk for the next 10 years. And we can't do that unless you have an efficient spot price, because if you don't have a spot price, you don't have a future curve. If you don't have a future curve, you don't have off-take agreements for all of the projects. If you don't have off-take agreements, you don't have insurance, right? So we really see this as the end goal should be make this as simple to do as any other sort of commodity hedging process out there that a Fortune 500 CFO can get from their bank. And that requires little pieces of what everybody here is doing.
And focusing on what you just said, isn't that taking the responsibility away from corporates to actually clean up behind themselves? But by simply outsourcing it, is that every ton is the same ton, just offset it, we just keep on doing what we do. How do you mix those two things with corporate responsibility and the efficiency of a fully transparent market?
Oh, I didn't actually say that the corporates, I love the line of questioning. The corporates still have to care. And by the way, I think an efficient market will actually very rapidly figure out that it turns out that at certain prices of carbon, it is a lot cheaper to just clean up your buildings, for example, or clean up your grid, right? But we can't figure out what those prices are without a deep and efficient market, right? So I think the invisible hand here will have a lot in driving these Fortune 500 CFOs to figure out the right thing to do here. But at the end of the day, we can't get anywhere near this, and the fat middle of the market is not, frankly, going to care about carbon offsets unless we make it really easy for them to do stuff the way they're used to doing it as CFOs, right?
And Tommy, in that sense, on making it more commoditized, easier, accessible, more transparent, are you thinking of, let's say, like your credit agency, you have from AAA to junk and ultimately D, are you considering a sort of similar skill, or how do you think that a rating should be easy to understand for, let's say, non-carbon specialists?
So maybe it's useful just to tell you where we're up in terms of our business. No, so we have the rating scale. It uses the financial industry benchmark, so it's AAA to D. We've rated about 350 projects today. That's about 54% of credits outstanding in the market. There's about 17,000 projects. But the majority of those projects are absolutely tiny. It's a bit like stocks in like the Russell 3000 versus the FTSE or the S&P 500. We also have a pre-issuance product, which I think is very interesting and growing. So no, that's already quite entrenched. I mean, we've got nearly 100 clients worldwide, most of the major banks, commodity houses, energy houses. So they're kind of used to this idea of a simple rating scale. I really like the idea that really it's ultimately about having an inflationary price. And that's kind of what the whole point of this is. It's pricing your emissions and getting people to say, you know, how do you pay for your impact, which is a lot of what you're talking about, Craig. And institutionalizing it is a means of saying, you know, another way of saying what you're saying was, it's not really a sustainability activity. It should be a core cost function management part of the business. You know, if you're saying you call up your JP Morgans, to name check them, and say, you know, help me with these processes, it's not some debate amongst some sustainability professionals. It's like, this is a fundamental, regulated, obligated part of my business. I must decarbonize. I must do something about it. And the services and functions that I need are mature enough, well understood enough to be readily available in a manner where they're efficient, the price signifies quality, the information around it is clean, it's backed by good disclosure, it's backed by clear rules, and that ultimately you can rely on it to make credible claims or whatever you're doing with it. So we have a very well entrenched rating scale. I mean, maybe just give you one point, probably none of these people in the room, but we do change ratings sometimes. You know, the ratings are dynamic. New information comes out all the time. I'd say on an average basis, a third of the projects that we've rated issue new information on an annual basis. And just to give you a sense of the impact, I genuinely get sued by people who are on the other side of trades for ratings that are downgraded. So if you want to have clearly they don't succeed, but like if you want to have a sense of like what the impact is of what we're making, people are taking notice of these things. And yes, there's a long way to go, and yes, they're parts of the same puzzle. But I think the market is institutionalizing, and it needs to institutionalize towards the language of capital, because obviously, ultimately we're coveting capital into conservation. So instead of just fixating on just talking about conservation language, we've got to figure out how to speak finance. That's one of the big challenges with conservation space. And it's happening, but it's happening actually quite quickly, but it feels quite slowly for those that are involved in it, because you want it to be yesterday, yesterday, yesterday. But in the space of 2 years that we've been, a year and a half at the rating agency, 3 years in the market, I mean, it's completely different, right? You know, there was like 5 players in 2019, and now probably there's 100 of these people in the room who've set up, including us and Flo and others and Kita in the past 3 years. So the dynamism's there, the energy's there, but it needs to shift towards that institutional model, and I think that's the right way to scale it.
And James, following up a little bit on the theme we are now touching upon, insurance is all about data, historical data, a lot of math, actuarian. Good luck in this industry. So how do you come up with your premium? How do you run an insurance business? Even though I think all of us in this room understand how important it is as an ingredient to get finance done, but I can assume it is very, very difficult. And how do you avoid that you add an unnecessary risk premium to it to be at the safe side of your business?
Yeah, okay. So, I mean, we have a sort of multi-factor model, as you'd expect, that kind of categorizes into like 7 broad buckets, but it's really about trying to find what are the data sets that are out there that we trust, and then build proxies sets where there isn't that data, and then do some model on sort of the emerging performance of the market, model on other proxy markets as well that we can use, say, commodity markets, renewables markets. And then there is a little bit of an error rate that over time will decrease. So the great thing now is that data's pouring out everywhere. The technology is rapidly increasing. So there's great sort of data ingestion technology. There's the sort of language ingestion technology. They say insurance is where law and the maths meet, and it's kind of how do you take all this data and understand the PDDs, et cetera, and kind of scrape those as quickly as possible. So that's the future state. But it's around those sort of proxy sets, particularly around credit default risk. So I came from a more generalist insurance background, and there the biggest concern at the moment is about secondary perils. So historically in insurance, you think you're worried about hurricanes and earthquakes, those are your massive risks. But these days, they are almost becoming sort of secondary to wildfire, convective storms, tornadoes, flood. And we've seen it in the US this year. It's had, over 30 or 40 different billion-dollar insured events this year, none of which were sort of major hurricanes. But and then up in north in Canada, they had sort of 16 million hectares of forest burnt this year, which is half the land area of Italy. So it's only getting worse. So that's the biggest concern in the insurance world. But actually, for this risk, that is a concern. But it's really the default risk, because like Till was saying, 80% of these developers only do one project, so they have no track record, and that's one of the key things that we're looking for. Like, what's your track record, both financially, in your sort of performance, executive lives, and from sort of project development. And if it's not there, then we have to kind of assume the worst, unless sort of told otherwise.
Yeah. And Till, how are you making use of these new providers effectively in the market, and how do you make sure that your platform stands out? Because we're all looking at the same projects, we're all looking at the same risks, and yes, we take different lenses, but so how do you sort of separate from the crowd and attract people to your platform?
Yeah, that's a good question. So you mentioned at the beginning, so we've worked with around 50 projects on the platform so far. We're roughly bringing 5 new projects to the platform per month, and we only choose kind of 1 out of 4 projects that we see to come to the platform. So every month we would screen up to 20 projects, run a developer KYC, have a look at developer host country framework, then see if we get enough data to be able to run our risk assessment, and then we take the 5 best projects to the platform. As you said, kind of having a unique pipeline is probably what it's all about. So we're securing exclusivity on what we consider landmark projects from track record developers to make sure they're kind of only available to investors on our platform. And in a lot of discussions, we kind of facilitate investors and developers to insurance providers. When we started out with Maya and we're trying to match projects and investors, there weren't any pre-issuance ratings in the market. They've kind of come to market more recently, which is why we started working on our own ones. So it's great to see that there's more solutions coming to market. And so far we're kind of doing it ourselves, looking at similar pillars. So we're rating, we're not rating, but kind of assessing developer and host country framework, permanence, additionality, carbon calculations, and lastly co-benefits. Give a score on each of these 1 to 5. We're not doing an aggregate score yet, but let's see.
And as you have recently announced to drop your fees, what is your business model behind it? Are you making so much money anyways, or what is it?
Yeah, it's a good question. So we started out with a brokerage approach, taking basically a fee on invested capital on the matchmaking service that we provided. And what we saw is that we facilitated a lot of discussions, but then they were just dragging, and it's at the core of what we do to accelerate discussions, right? So we want to really accelerate investments and massively accelerate capital deployment. And that's when we started writing our own risk assessments, and we saw they had a huge impact on the speed of those discussions. But there was obviously a conflict of interest in us being incentivized to close the deal and at the same time write the risk assessment for that project. And we saw that was actually providing a lot of value. So we decided to drop kind of brokerage fees on our platform and move to a subscription model. So now investors subscribe to our platform, they get access to our investment-ready pipeline, which are 5 projects per month that I mentioned. They get access to the risk assessments, and we can make sure we don't have any perverse incentives within that.
Great. Greg, back to the investment world. Are there particular areas you focus more on? Because you see there is a massive uprise. Recently I spoke to someone who said we moved away from solar and wind because that market is actually well developed. We are now far more focused on regenerative agriculture. That's one question. And the other is, what kind of investments do you make? Equity, debt? Do you have a minimum amount of equity you want to obtain in those transactions? How does it work?
Yeah, absolutely. So we are typically, where our rubber meets the road is in 2 places. One is as venture capital investors investing in the enabling technologies for the market. And then separately as call it real assets investors, because we do have sort of infrastructure type funds in actual projects. And the 2 things we're looking at in each of those categories. On the enabling technologies, we are looking for anything that can bring more trading on screen. So right now you have round about, depending who you trust on these numbers, it's difficult to get these numbers, about 80% of the total trades out there are happening off screen, right? It's an old school 1985, over-the-counter type market, right? That world that I was describing, where your Fortune 500 CFO doesn't have to hire a carbon trading team and instead can just ask JP Morgan to hedge their carbon risk, can only happen if a significantly larger portion of the global trading is happening on screen, right? So here we look at enabling technologies like flow, like tokenization, things like that, to try and bring trading on screen. And there's a bunch of enabling technologies there as well as enabling pools of capital, right? So a lot of the reason why those trades aren't happening on screen right now is there's no counterparty for it. The average trade in the market today that happens on screen is about $20,000. So if I happen to be the CFO of a Fortune 500 company and I want to go and hedge my entire year's risk and it's $5 million, there literally isn't a counterparty. There is no market maker. There's no citadel of this market who's sitting there willing to take it. And that's why these trades are having to go off screen, right? So that's one bucket we're looking for. The second bucket on the project side is how can we increase the individual bite size of sizes of projects. If this market is going to go from where it is today, which is round about, last year was like $2 to $3-ish billion traded. This year was supposed to be more. I think it might actually net out at less. But where we know the market has to go by 2030 is into the hundreds of billions of dollars. We are not going to get this market there on an average bite size, and you can probably tell me this better, like an average project out there I think is around about $1 million, right? We're not going to build a $500 billion asset class $1 million project by $1 million project. We need bite sizes similar to the oil and gas industry, where you're looking at $50, $100 million, $500 million type projects out there. And right now the infrastructure to even underwrite a project like that, to track that many trees, like whatever it happens to be, is very nascent. And that's the other part we're looking for on the actual sort of project management sides.
And actually, there's a question for the other panelists as well. How do we scale this market? Because the ingredients are becoming organized, but it's indeed still 2-3 billion, and it needs to be at least 50 times bigger. So what is your personal view on what are the triggers that can actually move us forward here?
So there's two real debates in the carbon market. One is supply side integrity and one is demand side claims. So how do I know it's good and what do I do when I buy it? That's basically everything that you'll ever hear in a nutshell. And every solution is part of basically that. And so yeah, you need to have good institutional rules, so disclosure requirements, methodology, standards, etc. And there to be coalescence around this represents enough confidence. For some people, that's the UN coming in and it being Article 6 markets. It could be the voluntary creation. It could be totally killing the VCM and just going towards tax or cap and trade, right? Those are all options. But coming to the VCM. And on the demand side, it's just clarity on how you can use these things. I mean, really, in economic sense, it's about pricing your externality. The claim is a marketing gimmick, but people want to be able to make claims. So you could say one of the biggest things is you need transition frameworks that allow you to use carbon credits to help make your net zero transition. Right now, the leading transition framework says don't buy anything, and if you do buy something, buy removals in 20 years. It's kind of a bit of a dam, right, in the flow of demand, right? I'm not going to say the institution's name, but it's science-based targeting. So, that's a big issue, right? So these institutions that are guiding the corporate journeys need to say these are recognizable instruments that you can use. Another big thing, if you really want to know the big bang, the thing that's going to cause Greg's funds to return, it's when voluntary carbon credits are considered equivalent to compliance credits. Because the compliance market is 800 times bigger than the non-compliance market. And let's see how many people in Climate Week in New York are talking about compliance markets. Like no one, right? So it's 800 times less interesting to talk about emissions allowances as these incredible, innovative, new technologies, new nature processes. And so yeah, you need to have the systems that allow you to use them, and you need to have a pathway towards it being included in national targets, which is really the big game, because ultimately corporates feed into national targets under the new Article 6 and Paris agreements, and that's going to be the game. So if you're a net debtor economy, you need to import carbon, and if you're a net exporter, of which is only 7, that's different. And so you've got to get that. Those are the things that are going to really scale it. You need an absolute fundamental bid at the end of the value chain that says, these are the things that I'm going to buy that are going to help me transition. And then on the supply side, just enough agreement, whether it's a risk-based approach or a standardized approach, that these are actually set up to succeed. And that's basically
and James,
not giving you much to talk about,
no,
sorry.
No. But for sure, Kita wasn't founded because you believe that 2 billion is the size of the market, of which probably 10% will use insurance. So where do you see the growth coming from, and where are you particularly focused upon to get that traction and sell your policies?
Well, firstly, Tommy, that was a fantastic answer. You kind of covered everything there. So I think we initially thought our product would be more of a kind of cookie cutter, off-the-shelf product. And I think as the carbon markets have reacted this year, the corporates kind of pulling back because of that inability to claim and uncertainty. We'd argue that insurance is a nice sort of backstop for that anyway, so hopefully they can encourage their investment anyway. But in that place, the institutional investors, and the light at the end of the tunnel for us is we are seeing more institutional investors coming in, and they're looking at a sort of scale of 10x, 100, the 50 million that you mentioned, and that's fantastic. And they have a very strong appreciation for risk, a very structured finance, project finance approach like you would expect in renewables. So we sort of commend that, and we're working with those sort of partners to kind of structure our insurance around that. So.
Until let's fast forward a few years, the market has exploded 50 times bigger. How would you survive with your platform if the market would indeed go through that massive growth? How are you equipped with your scalability on your platform to adapt because for sure you are also hoping and wishing that this market would explode.
Yeah, for sure. I think project finance is always going to be the first step to bring new projects to market, right? So today the pre-issuance segment is at 5x the size of spot markets because apparently investors expect spot markets to grow, right? So they find there's a lot of volume to come to spot markets. At one point that's probably going to balance out. But I think we're always going to have to educate investors around the risk of financing new projects if the market is at this size or 10x the size.
Not so much opening up to the floor, but if there are specific questions, please raise your hand and then we can incorporate it into the discussion. So what else do we need in this market? And I would actually look to the client in this case, sort of. What are you missing? One of the things I have heard relatively little about is, let's say, data science. The terms are used a bit. Is it still too early? Is it still too much 1985 and therefore, let's say, what you saw was open outcry before it became screen trading and the quants came involved? Is it simply too early for that, or where are we on that maturity curve?
Well, I think let's first just define who is the client here, right? Because I think as in any commodities trading market, right, you have the actual users of the commodity. So if we're talking natural gas or oil or orange juice, like there are companies who need orange juice, right, in their business practices. That is one type of clients. And then you've got speculators on top of the market. And in most of the commodities markets, the ratio here is around about 5 times the amount of trade and speculation as there is an actual like using of whatever the commodity is. Rough numbers, you know, a rule of thumb. So let's maybe break it down. What do each of these different people need? I think I've flogged the dead horse on what the end consumers of this commodity need. That is the corporates who need to buy carbon offsets. They actually need to do less. Like they don't want to hire their own carbon traders. They just want to be able to outsource this and make it easy, right? So there, I think it's about scale. It's about having service providers like the banks or Flowcarbon or someone else here, not to name names, right, to just make it easy for a Fortune 500 CFO to just make that trade, right? Now, the speculators, however, on top of that, this is where data science and data feeds and effectively having like the Bloomberg of this space really helps. And here we can use good analogies for going from 1985 over-the-counter trades to where the derivatives market is today, to where you've got, you know, people. This is not in my background, but I actually used to run the trading infrastructure for the prime brokerage at Citigroup, and you had people who, at the time, this was early 2000s, paying $1 million per month to cut 1 foot off of the length of an Ethernet cable, so that they had lower latency to be closer to the trading, right? It's that sort of level of these sort of like heavily data-driven type trading stuff that people need to give to those speculators. But before any of that can happen, who wants to speculate in a $3 billion market? Like, it's piddly, right? So before any of these things have to happen, our attitude is make it easy for the corporates, because the corporates will then go out and buy more, get more trading happening on screen, and get the bite size of projects up. If those 3 things happen, that unleashes this going from a $3 billion market to $100 billion to $500 billion, and then all the speculators will come, and then automatically by bringing speculators in, you get that 5 times trading uplift.
Okay, interesting, because if too many speculators come into a market, you might end up in a situation that people say, "Ooh, it's actually the money wolves have now entered. It's no longer ESG focused. It actually has become."
I would argue that's a good thing, right? That's a good thing because it drives capital into the market, right? It might mean that all of a sudden the person inside your corporation who's dealing with carbon isn't your ESG team anymore, and it's the CFO's desk. And again, I would argue that's a good thing, because guess who drives all the capital inside the world's Fortune 500 companies? I think probably everybody in this room would agree with me. It's not the ESG team, right? Unfortunately, I wish it was the ESG team, but it's not. It's the CFO's desk, right?
And actually, we do see that happening with corporate clients, where the carbon purchasing has moved away from the ESG team to just a part within the procurement organization. So Tommy, how many competition do you need, like, let's say, of other BeZeros to get more credibility into your rating?
What's the natural market structure of a ratings industry? Typically 2 big players, a third, and a tail. And that's kind of how it's emerging.
And do you expect that, let's say, the credit rating agencies start developing this much more aggressively? Of course, they are looking into this market, but when do you think they will jump on the bandwagon and there will be
Yeah, so yes, they're not going to, well, I imagine, not that I'm talking about my business here, but we know them. There's only 3. Moody's are starting to get into the space, but really S&P and Fitch have got a bit of a profile. There's maybe 1 or 2 others, people like MSCI, some of the ESG ratings. I don't think that they are intending to go out and hire 70 PhDs from world institutions and spend 20 million a year building geospatial software. That's not how I think they're going to play. These are acquisitive organizations who will try to bring you into the fold, either through partnership, acquisition, or sometimes a strategic deal. That's how it will play out. Whether we're one of those, I don't know. But look, I think that what makes them change, and you talked about the size of the projects, to really have a meaningful flow of business for these people, they have to be essentially, ratings need to be an integral and essential part of the value chain. So they're just a fixed cost in the value chain. They're not this nice to have. And you need to have really large scale projects that can commission proper fees from, because this needs to be, the total, I don't know the exact number, but the total revenue of ratings right now, the entire industry, I'm going to put it out there and say it's probably somewhere between 6 and 10 million, right now. That doesn't get S&P out of bed, right? So, and because of financial largesse in 2021, we're sitting on some quite punchy valuations. So for us to then come and acquire that, they're going to be acquiring you on multiples that they're not going to be happy buying you on. So what needs to happen is you need to get a real uptick in revenues for them to want to get involved. But likewise, engineered removal, which is the area they're most interested in, these are billion-dollar projects. Yeah. These are projects that require genuine arms of people coming in and doing risk analysis. In fact, it's different to Maya, but our biggest competition with Ex-ante is to disrupt the consultants, essentially, because our product is a lot more cost-effective than bringing in the big 3 and spending 6 figures, 7 figures with them, and in my opinion, much better. And S&P are sitting there going, well, that's kind of interesting. That's a $50 million bucket. That's a $100 million bucket. These guys, that's where the action is. So they're going to wait and see. They're getting very interested. They're talking. I don't think they're going to build it themselves. I think they're going to watch what the market does, let us take the risk, and then see, make us do some merry dance for 5 years. But that's how I see it playing out, basically. Yeah.
And James, when do you think, let's say, the big names are getting into your space? And thank you very much for all the hard work you have been doing. And then they copy your business model and then say, but we are the big, name all the big brands. And yes, at one end it would be actually fantastic because it means you have done the right thing. At the other hand, that's not what you're looking for.
I'd say it is what we're looking for, because we're, for this to scale, it needs massive capital to support it, and that's going to need many, many players. And on these larger deals that sort of the institutional investors are looking at, we don't want to write 100% of that risk. That's too much. We want that to be syndicated like it would be in project finance. So, and then the big players are already in the market, but they're sort of behind us. We've got Munich Re, Renaissance Re, Chaucer, big, well-capitalized reinsurers and insurers that are very keen on this space. So this is their way to sort of dabble in the market. But I think longer term, the key thing in insurance, in any product line industry, is really knowing the risk and having that understanding of the risk. And you can only get that from really being close to your clients, close to all the data sources, and that's something that's hard to replicate at scale, especially in a very emerging space. But we definitely welcome it, and a lot of my job is just canvassing the insurance market and saying, hey, there's fantastic opportunity here. Here are the risks, but here's the opportunities as well. And love to partner with you guys when you're ready to enter the space. So.
As we are running out of time, I want to end with one last question for Greg. As you are sitting down with CFOs, when will the time become that actually, when they publish their annual report, that their profit is shown per ton of emission? So that there will be a complete new benchmark and no longer say, oh, we had a fantastic year, but actually our greenhouse emissions were X to deliver Y.
I think there's a very different answer here between Europe and the US. In the US, the moment the SEC makes that a requirement, and no sooner, right? In Europe, we're actually already seeing that happening because they do have many reporting standards there that are making it. They're not as stringent as where we would like them to go, but it is actually already happening in Europe to a certain extent, and it's phasing in, and the legislation is actually already written and it's out there, right? But we are all sitting here waiting with bated breath for that SEC. They put out the guidance, it's been in public comments, and it's when the hammer comes down, which I think it actually might relatively soon here, that's when they're going to be forced to do it, because it's just going to be a requirement.
Great. Thank you so much for being on the panel. Give these guys a hand. Thank you.